Let me ask you a question to start. What if I told you that one of the most profitable companies in human history, a company that powers the email you read this morning, the cloud that runs half the internet, and the AI tools that are reshaping every industry on the planet? What if I told you that company is currently on sale? Not a 5% dip, not a 10% correction, a 35.7% crash from its peak. That company is Microsoft, ticker symbol MSFT. As of March 27, 2026, when I'm recording this video, Microsoft shares are trading at $356.77. Just months ago, in mid-2025, the stock had an all-time intraday high of $555.45. That is a destruction of over $1.476 trillion in market value. And now here's what makes this interesting, and why you're going to want to stay with me for the next 15 minutes. This is not a company that missed its numbers. This is not a company losing customers. This is not a company whose technology became obsolete overnight. Microsoft just reported record revenue. Its cloud business is growing in nearly 40% per year. It has $625 billion in contracts already signed with customers. So the question is, why is the stock down 35.7%? That is exactly what we are going to unpack today. And by the end of this video, you will understand something that many retail investors currently do not, which is why the panic happened, what the real risks are, and what questions you need to answer before you make any decision. Let's get into it. This video is for educational and entertainment purposes only. The views expressed are personal opinions and should not be taken as professional financial advice. Always do your own research and consult a qualified financial professional before making any financial decisions. To understand where we are today, we need to go back to January 28, 2026, earnings day. Microsoft announces $81.3 billion in revenue for the quarter. That is a new all-time record, up 17% from the same quarter a year ago. Operating income of $38.3 billion. The business is basically doing very, very well. But the stock fell sharply, nearly 10% the next day. Now, if you've never followed markets closely, that might seem insane. How does a company report record revenue and immediately lose hundreds of billions in market value? Welcome to Wall Street. Here's what happened. There are these things called whisper numbers, not the official analyst forecasts you read in the news, but the private expectations that big institutional investors hold in their heads, the unofficial bar. And the whisper number for Microsoft's cloud platform, Azure, was 40% growth. Azure came in at 39% in reported terms, or 38% in what's called constant currency, which just means stripping out the effect of foreign exchange rates. 1 percentage point, maybe 2, that is what triggered a $357 billion valuation collapse. But that wasn't the only thing spooking investors. At the same time, Microsoft revealed it plans to spend $146 billion this year on physical infrastructure. Data centers, AI chips, power grids, that is a staggering number, and investors started asking a very simple question. When can we see the returns? And then, just 2 months later, on March 26th, news broke of a quiet hiring freeze in Microsoft's cloud and North American sales divisions. Nothing dramatic, no press release, just a pause. But in a market already on edge, it lit the fuse again. So that is the anatomy of the panic. A record revenue report, a 1% miss on a whisper number, a spending figure that scared people, and a hiring pause that confirmed their fears. But here's the thing, and this is what I really want you to think about. Panics are rarely the full story, so let's go deeper. I want to take you back to the 1880s for a moment, the American railroad boom. Investors were pouring money into railroad companies very rapidly, and then suddenly they started pulling it out just as fast. Because here's the truth about building railroads. It is incredibly expensive. You need to buy the land. You need to hire thousands of workers. You need to lay hundreds of miles of track before you earn a single dollar of revenue from a single passenger. In the short term, the balance sheets of railroad companies looked terrible. Costs were exploding. Profits were crushed. Investors panicked. But the people who stayed patient, the ones who understood that those tracks would one day carry everything, goods, people, commerce, across an entire continent, they ended up owning the economy. Now, here's why I'm telling you the story. Microsoft is spending $146 billion this year building what I like to call token factories. That's my shorthand for data centers, those massive physical buildings filled with specialized AI chips that generate the intelligence behind every AI product you use. ChatGPT runs on them. Copilot runs on them. Every AI startup on the planet needs access to them. Microsoft is building this infrastructure, and then it is renting access to the entire world. Look at the spending roadmap. $65 billion last year, $146 billion this year, projected to hit $191 billion by 2028. These are analyst estimates, but the trajectory is clear. The tracks are being laid. They are expensive. They are crushing short-term cash flow, and investors are panicking, just like they did in the 1880s. The question, and I'll come back to this at the end, is whether you believe those tracks will one day carry the economy. Now, let's talk about what's actually happening inside Microsoft's cloud business, because this is probably the most misunderstood part of the whole story. The narrative you hear in the press is likely this: Azure growth is slowing down. And on paper, that's technically true. Growth decelerated slightly compared to the quarter before. But here is what almost nobody is talking about. On the earnings call, Microsoft CFO Amy Hood said something extraordinary. She said, and I'm paraphrasing here, that if Microsoft hadn't been forced to save its GPU capacity for its own internal tools like Copilot, Azure's growth would have been over 40%. Let me make sure that lands properly. Microsoft is not growing slowly because it's losing customers. It's growing slowly because it cannot build data centers fast enough to serve all the customers trying to give it money. That is not a demand problem. That is a supply problem. And there is a world of difference between the two. To put this in context, imagine the most popular restaurant in your city. It has a 3-month waiting list. It's turning away hundreds of diners every week. If you judged it purely on the number of meals served this month, you might think it was underperforming. But the real story is that the demand is overwhelming the capacity. That is Azure right now. And when you look at the competitive landscape, AWS growing at 24%, Google Cloud growing at 48%, Azure at 39%, Azure is not the fastest growing, but it holds 23% of the entire cloud market. It is the second largest cloud platform on Earth, growing at nearly 40% per year, supply constrained. When those new data centers eventually come online, that supply constraint goes away. I want to shift gears now and talk about something that I think most retail investors are completely underestimating, which is how Microsoft plans to charge for AI going forward. Think about how we all started using AI. You go to ChatGPT, you type a question, and you get an answer. That's generation 1. Ask the AI a question. Very cool, but very limited at the same time. Now think about what generation 2 looks like. Instead of asking an AI a question, you assign it a task. You say, go through my inbox, find every client complaint from the last 30 days, draft a response to each one, and schedule follow-up calls. The AI goes away, does all of that autonomously, and comes back with results. That is what Microsoft calls agentic AI. And on March 9th, 2026, just 3 weeks ago, Microsoft launched the product to monetize it. It is called Microsoft 365 E7, priced at $99 per user per month. Now, that might sound like just another software subscription, but here's what makes it significant. The previous version, E5, was $57 per user. Microsoft just raised the effective price per seat by 74% in one move. And they justified it by saying, we are no longer selling you tools like Word and Excel. We are selling you labor, an AI that works for you. On top of that, they launched Agent 365, a standalone product at $15 per user per month, launching May 1st, which lets companies manage fleets of AI agents, each one acting as a digital employee with its own access rights, its own audit trail, its own governance controls. Here's the number that should get you excited. Microsoft has 450 million commercial Microsoft 365 subscribers. As of February 2026, only 15 million of them, that's 3.3%, have upgraded to a paid AI tier. Think about what that means. 97% of the potential market hasn't moved yet. If even 20% of those 450 million seats eventually upgrade to E7, that revenue growth would dwarf everything we've seen so far. The question I'll leave you with here: how soon will those 20% switch on? Now, I have to address the elephant in the room because I know some of you are thinking it. If you've been paying attention to financial news in early 2026, you've seen this word everywhere: SaaSpocalypse. And I want to be honest with you, this is not a made-up fear that I'm going to dismiss. This is real. It is happening right now, and it hit Microsoft's sector hard. Here's what actually occurred. In February 2026, approximately $285 billion in market value was wiped from global software companies in a 48-hour window. By March 2026, an estimated $2 trillion in total market capitalization had evaporated from the software sector. Not from bad earnings, not from a recession, from one simple, terrifying realization. For every autonomous AI agent deployed, companies were reducing their human software seat requirements by a ratio of roughly 1 to 5. Think about what that means in plain English. If your company used to employ 100 salespeople, each with a Salesforce license, and now 10 AI agents can do the same work, you don't need 100 licenses anymore. You need 10. The software vendor just lost 90% of their revenue from your account overnight. Atlassian reported its first ever systemic decline in enterprise seat counts. Adobe shares dropped 36%. Salesforce fell 33%. These are not small companies. These are the giants of the software world, and they are genuinely struggling. So yes, the SaaS apocalypse is real. The fear is justified for most software companies. Now, here's the critical question. Is Microsoft most software companies? And this is where the story gets interesting. Think about what Microsoft actually sells at the infrastructure level. Azure is not a per-seat product. Azure charges by consumption. The more compute, storage, and AI processing a customer uses, the more they pay. It does not matter whether the user is a human being or an AI agent. In fact, AI agents consume more Azure resources than humans do, not less, because they are running around the clock, processing enormous amounts of data, executing tasks continuously. Investors shifted capital toward AI infrastructure and compute providers, which is exactly what Azure is. The same wave that is destroying per-seat SaaS companies is accelerating demand for the infrastructure underneath them. Think of it this way. When cars replaced horses, the people who got hurt were the horse breeders and the saddle makers. But the people who built the roads, they did not care whether you were riding a horse or driving a car. They just needed more roads. Microsoft is not in the horse business or the car business. It builds the roads. And in a world of AI agents running autonomously at all hours of the day, the roads need to be wider, faster, and more numerous than ever before. Now, is Microsoft completely immune? No, and I want to be transparent about this. The AI scare trade is the market realizing that in the agentic era, a company could grow its output by 10 times while reducing its headcount, and that does put pressure on Microsoft 365 seat volumes. If companies need fewer human employees, they need fewer human M365 licenses. Microsoft's answer to this is E7 and Agent 365, repricing upward and charging for agents directly, which we discussed on the previous slide. Whether that repricing fully offsets seat compression is the key variable to watch. It is not guaranteed. It is a calculated bet. But here is the bottom line. The unit of value is shifting from access to a tool to the completion of a task, and Microsoft, through Azure, through Copilot, and through Agent 365, is positioning itself on the right side of that shift, not as the tool that gets replaced, as the engine that powers the replacement. And I want to be honest with you here, the transition is not guaranteed to be smooth. Right now, 87% of companies are experimenting with AI agents, but only 12% have fully deployed them into their core workflows. The adoption curve is real, it's just early. This is a risk to watch, not a reason to panic.
Now, we need to talk about what is probably the most dramatic subplot in this whole story, the relationship between Microsoft and OpenAI. Let me take you through the timeline quickly, because context matters enormously here. 2019, OpenAI is a small, nonprofit research lab. Most of the tech world thinks it's an interesting science project. Microsoft quietly invests $1 billion. At the time, almost nobody notices. 2021, GPT-3 arrives and proves the technology is real. Microsoft puts in another $2 billion. 2023, ChatGPT takes over the world. Within 2 months, it becomes the fastest growing consumer product in history. Microsoft, already deep in the relationship, invests an additional $10 billion and announces that OpenAI will run exclusively on Microsoft Azure. Azure becomes, overnight, the home of AI. 2025, the relationship gets restructured. Microsoft now holds a 27% stake in OpenAI's for-profit arm, estimated to be worth around $135 billion. And, importantly, Microsoft secures perpetual intellectual property rights to all of OpenAI's models and research through 2032. We'll come back to why that matters enormously. Then comes 2026, and this is where it gets messy. OpenAI signs a $50 billion deal with Amazon Web Services for its new Frontier Agent platform, and every financial journalist on the planet writes the same story. Microsoft's most important partner just defected to the competitor. I want you to hold that panic. Before you write this off as a straightforward betrayal, stay with me, because the details here are much more nuanced than the headlines suggest. I am going to spend the next 2 minutes showing you why that headline, while technically accurate, is about as useful as reading only the first sentence of a very long contract. Let's get into them. Here is what actually happened, precisely. AWS is the exclusive third-party cloud distribution provider for OpenAI Frontier, the enterprise platform that lets organizations build and deploy teams of AI agents. That exclusivity is real, it is not spin. Amazon genuinely locked up the distribution rights to the most strategically important new OpenAI product. But here is the sentence that most headlines buried in paragraph 7. OpenAI's Frontier and other first-party products continue to be hosted on Azure, and all stateless API calls, the traditional model queries that the vast majority of enterprise AI applications currently run on, route through Azure, even those originating from Amazon partnerships. Let me translate that into plain English with an analogy. Imagine a premium whiskey distillery. All of their whiskey is still made in the same distillery. That's Azure. For years, they sold it exclusively through their own shop, also Azure. Now they've signed a deal giving a major supermarket chain, that's Amazon, the exclusive rights to stock it on their shelves for a new premium product line. The distillery hasn't moved. The whiskey is still made there. Azure still hosts the core product. But now, when a big enterprise walks into the Amazon supermarket and buys the premium product, the sale goes through Amazon's, not Microsoft's. That is the real situation. Azure keeps the factory, Amazon gets the shop front for the new premium range. Now, is this still a serious threat? Absolutely yes, and here is why you should not dismiss it. The enterprise AI market is moving from simple one-shot model queries, the stateless API calls Azure controls, toward persistent AI agents that remember context, execute multi-step tasks over days and weeks, and integrate deeply into business systems. That is precisely the stateful agentic workload that AWS now has exclusive third-party distribution rights over. In other words, Amazon captured the rights to distribute exactly the part of the market that is growing fastest. Microsoft executives told the Financial Times, "We will sue them if they breach it," expressing confidence their exclusivity agreement covers this territory. Negotiations between all three companies are currently underway, with the goal of resolving the dispute before Frontier goes fully live. So, what is my take on this issue? This is a genuine, meaningful, and unresolved dispute over who controls the fastest-growing layer of enterprise AI. It is not an outright betrayal. Azure still hosts the core product, but it is not a minor distribution quibble either. Amazon captured the exclusive rights to the AI future. The outcome of the ongoing legal negotiations will determine how much of that future revenue flows to Microsoft versus Amazon.
And that brings us back to the same question. What happens to Microsoft's $625 billion backlog if OpenAI's commitments unravel? Let's deal with that head-on.
Here's where the story gets interesting, and where I want to push back on something that I think most of the financial media is getting wrong. The narrative you keep hearing is, if OpenAI fails or walks away, Microsoft loses $281 billion in contracted revenue, and that sounds catastrophic. But let's think about what that $281 billion actually represents. It is not cash sitting in a vault that disappears. It is computing capacity, data centers, servers, GPU clusters that Microsoft has built and owns, physical infrastructure that exists regardless of who's paying for it. If OpenAI's commitments evaporate overnight, does that capacity sit empty? For a short period, perhaps, but OpenAI is not the only company on the planet that needs AI computing infrastructure. The waiting list for cloud capacity is enormous. Every major bank, every pharmaceutical company, every retailer, every government, all of them are scrambling to secure AI computing resources. The demand does not disappear because one tenant leaves. Think of it like a commercial landlord who has a single large tenant on a long-term lease. If that tenant goes under, yes, there is short-term pain, but the building still stands. And in a city with a severe building shortage, the landlord will find new tenants. The capacity is the asset. The contract is just the current occupant. That said, let me be specific with you about the three layers of Microsoft's actual position here. Layer 1, the IP rights. Under the restructured 2025 agreement, Microsoft holds perpetual licenses to all of OpenAI's models and research through 2032. This includes model access rights until 2032, and Microsoft maintains exclusive IP rights across OpenAI models and products. The technology is Microsoft's to use regardless of what happens to the company or the partnership. Layer 2, the talent play. Satya Nadella, the CEO of Microsoft, has reportedly signaled that if OpenAI were to fail, Microsoft would move immediately to hire its top researchers and bring the models in-house. And notably, Microsoft is already hedging against a potential split. It hired Mustafa Suleyman, co-founder of DeepMind, as CEO of Microsoft AI, and has been developing its own Microsoft Artificial Intelligence family of foundation models. Microsoft is not waiting to see what happens. It is building its own parallel AI capability right now, using OpenAI as a head start rather than a permanent dependency. Layer 3, the capacity argument. Even if OpenAI's $281 billion in contracted commitments were to disappear entirely, the data centers don't disappear. The GPU clusters don't disappear. The fiber, the power, the cooling, none of it disappears. It gets reallocated to the enormous queue of enterprises, governments, and startups that are desperate for AI computing capacity and currently being told to wait. Is there short-term pain in that scenario? Absolutely. Revenue visibility drops, the stock would likely fall further, and there would be a period of redeployment. That is real. But is it an existential threat to Microsoft's AI business? No, because the asset, the infrastructure, remains. The technology is licensed. The talent is being absorbed, and the demand from the rest of the world is not going anywhere. Here's the bottom line. Microsoft has already downloaded the value. OpenAI's survival helps. OpenAI's failure hurts temporarily, but neither outcome destroys what Microsoft has built.
Let's talk about a number that I think is genuinely extraordinary, and one that almost never gets the attention it deserves in mainstream coverage. $625 billion. That is Microsoft's commercial RPO. And I know what you're thinking. What on earth is an RPO? RPO stands for Remaining Performance Obligation. In plain English, it is the total value of contracts that customers have already signed with Microsoft, committing to pay over the coming years. It is as close to guaranteed future revenue as corporate finance allows. Think of it as a pipeline of money that already has your name on it. Not hoped-for revenue, not forecast revenue, contracted revenue. $625 billion. And it grew 110% in a single year. To put that in perspective, AWS, Amazon's cloud business, has a backlog of around $244 billion. Google Cloud has around $240 billion. Microsoft has more contracted future revenue than AWS and Google Cloud combined. Now, and here I need to give you an important asterisk. A very large portion of that $625 billion came from a massive OpenAI commitment signed in Q2. This was one enormous contract from one counterparty, not a broad diversification of customers, which is why the 45% concentration risk I mentioned earlier is real. But even if you haircut the OpenAI portion heavily, even if you assume the worst and write off half of it, Microsoft still has more contracted future revenue than any cloud competitor on the planet. In a world of uncertainty, that is a remarkably solid foundation to stand on.
We have spent the last 10 slides talking about risks, drama, and uncertainty. Now I want to show you what all of that fear has done to Microsoft's price tag, because this is where the story gets genuinely interesting for investors. There is a measure called the PE ratio, the price to earnings ratio. It tells you how much investors are willing to pay for every dollar of profit a company generates. Think of it as the sticker price on a company's earning power. A high PE means investors are excited about the future and paying a premium for it. A low PE means the market is cautious, skeptical, or simply afraid. Microsoft's PE ratio as of March 30, 2026 is 22.37. Over the last 10 years, the average PE ratio for Microsoft has been around 31x. The current ratio is 28% below that historical average. But here's where it gets striking. The average PE of the entire S&P 500, 500 companies, everything from banks to retailers to tech giants, is currently around 24.7 times. Microsoft, the third largest technology company on Earth, is trading cheaper than the average S&P 500 stock. And for context, Walmart is currently trading at around 44 times earnings. You can currently buy one of the world's most advanced technology companies at half the earnings multiple of a grocery and retail chain. Now, PE on its own only tells you part of the story, because a low PE can mean two very different things. It can mean a company is genuinely cheap, or it can mean a company is cheap because it is growing slowly and the low price is completely justified. This is where I want to introduce a second, more powerful measure. It is called the PEG ratio, the price to earnings growth ratio. Here's how it works in plain English. You take the PE ratio and divide it by the company's earnings growth rate. Conventional wisdom says a PEG of 1.0 or below means a stock is fairly valued or undervalued relative to its growth. Above 1.0 suggests you may be paying more than the growth justifies. So what is Microsoft's PEG right now? Using trailing 12-month earnings growth of 28.7%, Microsoft's PEG ratio comes in at 0.83, meaning you're paying less than $1 for every dollar of earnings growth the company is delivering. Let me put that in plain English with a comparison. Imagine two restaurants. Restaurant A has a PE of 15, looks cheap, but its revenue is growing at 2% a year. Its PEG is 7.5. You're paying a lot for very little growth.
Restaurant B has a PE of 22, looks more expensive, but its revenue is growing at 28% a year. Its PEG is 0.83. You're paying almost nothing for an enormous amount of growth. Microsoft is Restaurant B. The headline PE makes it look merely cheap. The PEG ratio reveals that at its current growth rate, the stock may be significantly undervalued relative to what it is actually delivering. Now, I'm not saying that makes Microsoft automatically a buy. Cheap can get cheaper. There are real risks we have already discussed. But what I am saying is this. The fear that is currently priced into this stock is extraordinary. And historically, when great companies traded this kind of fear discount, it has often represented opportunity.
Let me briefly touch on what the charts are telling us, because I know some of you are technical traders. The stock is rapidly approaching its 52-week low of $344.79. That is a level that market participants will watch very closely. If it breaks through, the next support levels are further down, but if it holds, it often acts as a launching pad. There is also a measure called the RSI, the Relative Strength Index. You don't need to understand the maths. All you need to know is that when the RSI falls below 30, it signals that a stock has been sold so aggressively that it has become, in technical terms, extremely oversold, like a spring that's been compressed almost to its limit. Microsoft's RSI is currently around 27. Now, and I want to be clear, this is not a guarantee of anything. Oversold stocks can stay oversold. Technical signals are one input among many, not a crystal ball. But here is the important date to put in your calendar. April 28th, 2026. That is Microsoft's next earnings report. It will be the first real test of whether the new data centers coming online are actually translating into accelerating Azure growth. If they are, the supply constraint narrative is confirmed. If they aren't, the bears were right all along. That date is the next major inflection point for this stock. Let me give you the honest bull and bear case side by side, because that is what good investors deserve. The bull case says Microsoft is trading at the cheapest forward multiple in nearly a decade. The $625 billion backlog provides revenue visibility that no competitor can match. Azure's apparent slowdown is supply-driven. The demand is real and waiting. The E7 pricing shift resets the revenue ceiling dramatically upward, and Microsoft's IP rights to OpenAI's models are secured to 2032 regardless of what happens to the partnership. The bear case says $146 billion in annual capex may take 6 to 8 years to recoup at current AI revenue run rates. Nearly half the commercial backlog is concentrated in a single counterparty that's burning $14 billion a year. OpenAI's Amazon deal directly challenges the Azure exclusivity arrangement. Xbox hardware revenue is down 32% year-on-year, a segment in structural decline, and the hiring freeze suggests management itself is worried about margin pressure. Both sides have merit. Neither side has a monopoly on the truth. Here is the concept I want to leave you with: priced in. When a stock falls 31%, it means the market has already assumed a lot of bad news. It has already priced in the OpenAI drama. It has already priced in the capex overhang. It has already priced in the hiring freeze. When everybody already expects disaster, the stock often has less room to fall, and the market tends to react strongly to even a modest positive surprise. The question is not whether the risks are real, they are. The question is whether those risks are already reflected in the price. We are nearly at the end of the video. Let me leave you with the 3 things that will determine which version of this story turns out to be true. First, April 28th, earnings day. This is the moment of truth. Microsoft's new data centers have been coming online. If Azure growth re-accelerates, if the supply constraint is actually easing, it will powerfully validate the bull case. If growth continues to decelerate despite new capacity, then something more structural is wrong and the bear case gains ground. Watch the Azure constant currency growth number closely. Second, the OpenAI legal outcome.
Has Microsoft successfully argued that all OpenAI cloud revenue must flow through Azure? Or does the Amazon distribution deal stand and expand? This question will determine whether $281 billion in backlog concentration is a manageable issue or a structural threat. Watch for any legal filings or settlement announcements. Third, Agent 365 launched traction on May 1st. The $15 per user standalone product launches in just a few weeks. Early adoption data will be the very first real-world signal of whether enterprises are actually willing to pay for AI governance at scale. This is the first chapter of the digital employee story, and the early numbers will set expectations for years. So let me bring this full circle. I started by asking you whether Microsoft was in crisis or on sale, and I hope by now you can see that the honest answer is it might be both simultaneously. The risks are real. The CapEx overhang is real. The OpenAI concentration risk is real, but the opportunity is also real. A company with $625 billion in contracted revenue, growing its cloud at 40% a year, with a strong position on enterprise AI software trading cheaper than the average S&P 500 stock, that is not a normal situation. The tracks are being laid, expensively, painfully, with investors questioning every dollar. The question, the only one you can answer, is whether you believe those tracks will one day carry the economy. Thank you for watching. If you found this video helpful, hit that like button and do consider subscribing to my channel. And do share what you think about Microsoft below in the comment. I will see you in the next video.